It is possible that the euro is in deep trouble right now. And I know there are many problems that plague every single fiat currency, but the euro does have some unique problems associated with it. And that's because the euro isn't controlled by just one nation. This presents certain struggles and, quite honestly, some advantages and opportunities for nations that would abuse that. And right now, some of those abuses might be stretching the euro to its breaking point. And if it does break, the final straw on the camel's back will likely be one of two culprits: banks or pigs. Ready? Let's dive in. In the past years, the ECB has been doing what many central banks around the world have been doing, and that is lowering interest rates and buying assets, all in the effort of stimulating inflation. But now inflation is starting to take off, which has been putting the pressure on to take their foot off the gas pedal. And this pressure and the hesitancy by the ECB has exposed one of the real goals of their asset buying programs and their low interest rates, which is to support the insolvent governments that are a part of the euro, specifically supporting their debt. Now, predictably, this has been extremely frustrating to some of the countries that are more financially responsible and have been in a better, stronger financial position over the last couple of years. They're simply tired of subsidizing these spendthrift nations. So as a result of this, a deal was struck that will reduce in the ECB reducing its balance sheet size significantly by about $1 trillion over just the coming 5 or 6 months. Now, the big fear is, what is this going to do to interest rates of government debt, especially of the pigs: Portugal, Italy, Greece, and Spain. And in this case, the weakest nation of those is probably Italy. Italy's debt to GDP ratio is well north of 150%, which is far higher than the limit, the cap set at 60%. And with the ECB letting its balance sheet run off, there are very few lenders out there with the capacity or with the willingness to lend at that high risk with the low rates that Italy can afford. Now, what are the options here for Italy? Well, if they default, they're basically screwing over their own citizens, because a lot of Italian debt is held by its own citizens. So that would be a very politically unpopular move. Another option is for Italy to try and leave the euro, which, if they do that, they're basically forcing all those losses onto the creditor nations like Germany, and the turmoil that would cause would not be pretty. So with the years of debt monetization and governments overspending, there really is no easy way out. But wait, there's more. It's not just the governments of financially irresponsible nations that have problems right now. Banks in the Eurozone are extremely fragile right now. In fact, the risk on the balance sheets of some of these Eurozone banks are what led to the repo market blowing up in September of 2019. See, for years, the ECB had been lowering its interest rates from 0 to -0.1, -0.2, and the month that they moved from -0.4 to -0.5 was, guess when? That's right, September of 2019. And in September of 2019, on the day that Deutsche Bank's prime dealership was moved to BNP in Paris, the repo market blew up. This indicates that US banks were refusing to deal with the high collateral risk associated with what was on the balance sheet of Deutsche Bank or some of the other European banks. And it's no wonder. Just look at this chart. You can see how absolutely highly leveraged these banks are in the Eurozone. And keep in mind, these are GSIBs. A GSIB is considered a globally systemically important bank. And this is how highly geared their balance sheets are, to where if their balance sheet lost 2% for these top 3 banks here, just 2% of the value of their balance sheet was wiped out. That would exceed their entire market cap. So the market is basically pricing these banks at close to bankruptcy levels. So what is on these balance sheets that is causing the market to price in so much risk here? Well, basically the balance sheets are full of what's called a relative value trade. A relative value trade is owning one thing and being short another thing that are almost identical but are priced slightly differently, so you can take the arbitrage between the two prices. An example of this would be shorting the shares of Google with voting rights and buying the shares of Google without voting rights. You'd take the small difference, the price difference there, and when Google goes up, they're both going to go up. When Google goes down, they're both going to go down. Your long and short positions will offset each other. But over time, the price should converge back to closer together if you get into the trade at a time when they're historically further apart. And they should not be able to, since they're virtually identical, they're both ownership of the same company, they should not be able to diverge forever. But guess what? Models that predict predictable things, by definition, can't predict unpredictable things. So when unexpected things happen in markets, which happen all the time, you get blow-ups on highly leveraged balance sheets that are based off of only predictable models. And so if there's an emerging markets failure as a result of the rising dollar and it causes spreads to widen past the point of these risk models that comprise these massively leveraged balance sheets, because remember, you can't make a lot of money by taking 1 cent here, 1 cent there, but if you can leverage that trade and use a ton of debt to get into these trades, then you can start making real money. And since they're considered risk-free because the models say, hey, they can't diverge forever, they can really load up on the debt. And inevitably, something unexpected happens and it starts to blow up these trades. It's happened many times before. That's what took out the hedge fund long-term capital management back in '98. That, again, almost took out the global financial system, and the Fed made Wall Street bail out the hedge fund. So something unexpected happening could easily snowball into unsustainable losses for any of these banks in the Eurozone. And the worst part is these are just the G-SIBs. There are other banks that are not considered globally systemically important that could be even more leveraged and be in a worse position because they're subject to less strict rules. Now, ironically, a crisis out of the Eurozone with the euro could actually lead to more demand for the dollar and strengthen the dollar and the US's financial position around the world, especially because banks in the US are far less leveraged. But the bottom line is this: both the biggest banks and the biggest governments all across Europe are extremely fragile right now. If the ECB were to do nothing, inflation would take off like a rocket. Because of this, as the ECB winds down its monetary policy in response to the inflation, it stretches its member governments to the breaking point. As rates rise, you have something unexpected become more and more likely, like an Italian default or something out of emerging markets that could very easily trickle over and spill over to a 1, 2, 3% loss on some of these highly geared balance sheets for these large banks. Altogether, this means that it is likely a matter of when we see major issues come out of the euro, not if. And it's anybody's guess how these problems end up being resolved. But when push comes to shove, over the last 100 years, policymakers tend to choose the easy way out. Long-term consequences be damned. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.